Welcome to another episode of Whiteboard Project Management YouTube channel. In this channel, we explain the tools and techniques used in the project management in a practical way on a whiteboard. So if you are new here and you are interested, consider subscription to the channel and don't forget to hit the notification down below to get all notification of the new released videos. In today's episode, we will explain the contractual bond and guarantees. So grab your cup of coffee and let's hit the whiteboard. Talking about contracts, each contract is passing through stages. Start from tendering stage up to contract signature, contract effective date, and executing of the contract, then completion, handover, and warranty period. So let's explain it here on a timeline on the whiteboard. We have timeline, and we have our tender starts here. So this is the tendering. The tendering starts with a milestone over here, and then for a period of time you have started your effective date of the contract, and while effective date of the contract up to the completion, the end is here. So let's explain through this life cycle of the contract what is the bonds and guarantees required. So during tendering stage, we have the bidding stage. We start with bidding over here. So we start with bidding, and then when the bid is completed, the contract is awarded, then you have the contract here. So this is the bidding stage, while this is the contract stage. Okay, we just defined that we have two stages, main two stages. One stage is for the bidding, the other stage is for contract. Okay, during the bidding stage, you have the bidding performance. What does this mean? Or what does the performance guarantee and the other guarantees, the bond means? Means the performance bond and the bidding bond and guarantee bond. Those are the three main bonds required during your contract execution. So first one I will mention here. Bidding bond. During your tendering, the contractor and the client agreed that the client requested some part of scope of work to be done from the contractor. The contractor is executing it, but the client need to ensure that the contractor is capable from his capability of completion, from financial side and from performance side, that he will be capable to deliver the required work, because not every contractor can deliver all what is required. So let me hit here simple two blocks, simplifying the two parties. One is the contractor and one is the client. So the client is requesting a contract. So there is a bidding stage over here for the contract, and the client need to be sure that the contractor is able to deliver this type of work. The client will request the contractor to issue the bidding bond. Now, bidding bond is to ensure that the contractor is ready or is capable, is not ready, is capable to deliver the required scope of work. The contractor contacts his bank. I will mention contractor bank. Okay, so he is requesting his bank to issue him a bidding bond. The bidding bond will be issued, and the contractor bank informs the client's bank that the bond has been set, and the client's bank informs the client about the issuing of the bond. Okay? Means the contractor during the bidding stage have to prepare his documents, everything to his bank. The bank knows the history of the contractor, knows which document he already did, knows his registration documents, his actual contracts, his actual cost, his actual cash flow, and capabilities of this contractor. So accordingly, the bank will make some internal auditing and checking with the contractor, and then the bank issued the bidding bond for the contractor, and the bank is not informing the contractor but informing the client's bank that this bid has been prepared, ready, and the client's bank informed the client that the bond is ready. Okay, once the bid bond has been issued and the client is being informed, then the bidding stage will complete. If the contractor get the awardance of the contract, then we start here with another stage. We start here with performance bond. This bidding bond is converted to be as a performance bond. It's a conversion of bidding bond to performance bond. In some projects, there is no requirement for the bidding bond, but there is requirement for the performance bond immediately after contract signature. And contract signature or contract effective date is a condition to the performance bond. So, okay, we have a contract signature. Sometimes contract signature doesn't mean the effective date of the contract, but the contract signature has mostly 2 or 3 main parts. One is the performance bond. This is the contractor's responsibility. The second could be mostly advance payment. That is mostly for the client side. And the third is the letter of credit. And this is mostly also for the client side. So when you sign a contract, that depends on the condition of the contract effective date in this specific contract. But from experience, most contracts which are in dealing with a huge amount of money, or for EPC contracts, The contract signature has some, after contract signature, there is a specified duration of time for a 1 month or 2 months that the contractor and the client has to fulfill some conditions to make the effective date of the contract. The conditions are mostly the opening of the letter of credit, which is on the client side, and the advance payment from the client side, sometimes depends on the payment of the milestones, as well as the performance bond, which should be done by the contractor, where the contractor has to check with his bank to issue the performance bond, and the performance bond according to the contract could be with 5% or 10% or whatever percentage agreed in the contract. Once the bank issued the performance bond, the bank informed the client's bank about the performance bond opening, and the client's bank informs the client that the performance bond is opened. Sometimes, if the contractor and the client is in different countries, okay, let's say this is something in Europe and this is something in the Middle East, the client somewhere in the Middle East. So you have two different regions and the banks are different in different regions. Each bank have his own regulations. In this case, the client's bank doesn't accept the foreign or the client doesn't accept the foreign performance bond from a foreign bank, but the client needs a performance from the client's bank, and the client's bank issue this performance to the client based on the agreement between the two banks. So there is another agreement here between the two banks, which this agreement is based on this performance bond, and the client issue to the client's bank issue to the client a performance bond, which is called counter bond. Okay, so if you hear the word counter bond, that means the client's bank, which is somewhere else in different country, issue this counter bond to the client based on the contractor's bank performance bond issuance. Okay, now we explained this bond and we are now in the effective date of the contract. Once the contract is effected, then the contract starts with its life cycle, and you have some milestones. If you are an EPC contract, then you have a mechanical completion, then you have the startup, or in EPC contract we call it PAC, Preliminary Acceptance Certificate, and then you at the end you have the FAC, which is the Final Acceptance Certificate. This is the Final Acceptance Certificate, and this is the Preliminary Acceptance Certificate. Okay, we will go through one by one so you will see it and you will not mix it anymore. Okay, performance bond is set on the effective date of the contract, and the performance bond is up to the start of the warranty period, because once you start up the unit you have a warranty period over here. So here you have a warranty period. Means I have a performance bond up to my completion. What is the performance bond for? The performance bond is an insurance to the client that once the contractor is starting the work, if there is any problem occurred during the execution of the work and the client or the contractor is not able anymore to complete the work, then the client can claim this stop of work to his bank, and the bank will claim it to the contractor's bank, and while the contractor's bank will claim it back to the contractor. So this is the whole story of the performance bond. From the beginning, you have commitment to complete the work, and the work is huge, so the amount is huge. So you start your performance bond somewhere here, and during the project, you are completing the project and you are moving onwards. So your responsibilities, your commitments are decreasing step by step because you are claiming your milestones, you are getting your money back, and the remaining amounts are less and less. Okay, so if I will make it as a line, you can see that within the time of your execution, the performance bond is reduced. It is not a fixed amount from the beginning to the end, but it's a reduced amount during the project execution. Okay, another part, once you are in the preliminary acceptance certificate, you completed your work and you started with your warranty period, which is specified in the contract. This could be 12 months, this could be 24 months, 4 years, 3 years, whatever is defined in the contract, you have a warranty period. During this period, you are committed to the client during your contract that if there is any damage occurred, you are going to be replacing this damage on your own responsibility and your own risk if the problem is according to wrong supply or whatever. So the client needs to ensure that you are really committed and you are not just taking all your money and leave, and he needs a guarantee over this period. This is the guarantee bond. So the client needs from you the guarantee bond for a percentage which is agreed in the contract. Could be like 5% or 3% or 2%, whatever is said, or 10%. So the client needs from you a guarantee bond because the performance bond has been completed and now you need to prepare your guarantee bond. So see the differences. This is why I wanted to explain it to you during the contract from the bidding stage. The bidding bond has been moved to be a performance bond. A performance bond starts from the effective date of the contract and it's for a big value at the beginning, but while you are executing the project, you are decreasing the performance bond, and once the PAC is here and you are in the warranty period, you have to prepare to the client. Before that, you have to prepare the guarantee bond to the client. Definitely the guarantee bond is from your bank. Okay, this is all through your bank. In some contracts, the guarantee bond is not issued from the from the contractor bank, but it could be as a percentage from the work done. Means I have here milestones, and from each milestone I will deduct, let's say, 2% to have it as a warranty. And once we are reaching to the PAC, I have deducted 2% from each milestone, and I am keeping it as a client. I'm keeping it up to the end, and here I will release the payment for you. And this is the guarantee for me in case, as a client, in case the contractor is failed to repair or replace the damage which is in the guarantee area, guarantee and warranty period. So, and the client will use this amount and deduct it from the final invoice. This is the simply flow of the bonds. And if there is any question you have, leave it down in the description down below in the comments, and I will be happy to reply to all. Okay, let's take an example and explain it in figures. We have example. We have a contract with a value of 100,000 US dollars, and your payments are 20,000. Then you have 50,000. Then you have 10,000, and you have 20,000. So those are your payment milestones. If you have your performance bond issued and everything is okay, let's talk about now the guarantee bond. So either you are issuing to the client a guarantee bond from the contract, or the client will say, okay, let me do something from each invoice you have, from each milestone, milestone 1, milestone 2, milestone 3, milestone 4, I will deduct a percentage or a lump sum money. So let's us say that during this figure, the client will deduct 5,000 US dollar from each milestone to save it as guarantee bond. So this is minus 5,000, minus 5,000, minus 5,000, minus 5,000. In total, I have here, I am invoicing 15,000. Here I am invoicing 45,000. Here I am invoicing only 5,000. And here I am invoicing $15,000. Okay. In total, the client is having with him 5, 10, 15, $20,000. The client is saving this amount as $20,000 for him as guarantee amount. So if I am having this timeline and I have my effective date over here, I have my preliminary acceptance certificate is here, and I have my final acceptance certificate is here. This is my warranty period, means this is the guarantee bond, and the guarantee bond amount should be available from this part. So here the amount of 20,000 should be ready, and here to be invoiced and released in case there is no problems. There is a problem, the contractor is committed to repair it. The contractor doesn't repair it, the client could claim it and back invoice it from this amount. So that means here I have the M1, M2, M3. Let's say M1, M2, M3, and M4. Means the 5,000 is deducted here, other 5,000 here, other 5,000 here, other 5,000 is here, and this is all cumulated to the client and already during your guarantee bond. This is the figure of using it as a guarantee bond. There is another way where the client will say, oh, okay, I will not deduct from you the percentage or the fixed amount from each milestone, but I will mention as one payment milestone at the end of the contract. Means the client will say, I will add M5 here with the value of 20,000 at the end, but these amounts will be only the new ones. Means another way, milestone 1 will be 15,000, milestone 2 will be 45, milestone 3 will be 5,000, milestone 4 will be 15,000, and milestone 5 will be 20,000. And another way that it is the same value, but the client is mentioning that I have the final invoice here at the end, and the final invoice is depending on some period of time. During why this is used? This is used if the contractor is not capable to prepare the guarantee bond or bank guarantee for the period of guarantee. This is the aim why it is used. So that's why they said, the client say, okay, I will leave one payment milestone over here, or I will deduct from you this amount of percentage from each milestone. Otherwise, the contractor can issue a guarantee bond, and the guarantee bond will cover this period while the contractor's bank is guaranteeing that the contractor will prepare everything. Okay, let me explain you another thing. Some people will say, okay, the performance bond or the guarantee bond is a type of insurance. Yes, it is a type of insurance, but it is not an insurance. It is insurance for the client that his work will be completed. So let's explain the physical, simple explanation between and differences between the insurance and the bond. When we talk about bond and we talk about insurance, the bond is made between 3 to 4 parties. 3 to 4 parties. The insurance is done between 2 parties. I will explain. What does this mean? In the bond, we said we have the contractor. We have the contractor, we have the bank, and we have the client. We have also the client bank. So either the client have the same bank, that means we have it as a 3 parties, or the bank is different and the 2 banks are communicating together, and we have a 4 parties for parties' involvement. While the insurance, you have the contractor and the contractor is making it with an insurance company. The insurance company, according to your insurance policy, insures for you that if there is something happened, they will go to pay for you some money. They are paying for you, not for the client. So the insurance policy, it says, if there is a big wind occurred, if there is a problems occurred, if there is a force majeure occurred sometimes, whatever, flood or whatever occurred, the insurance company will cover up to the limit specified in the insurance policy to the contractor. It's a contract between two entities, between two only, while here we have 3 to 4 entities. Okay, and the insurance company is an insurance company. It's not a bank. Here, this is a bank. Okay, let me draw a client here. And if there is something occurred, and during the insurance, the client send his claim. See, this is the important part, the differences between the insurance and the bond. The client sent his claim to the contractor. And if the contractor is having this part under insurance, he will send it to the insurance company. And once the insurance company completed, he can reply it back to the client. While during the bond, if there is a problem occurred here, the client send his claim to his bank, and his bank send the claim to the contractor's bank, and the contractor's bank send the claim to the contractor. You could say, okay, but this is more complicated process, but as a client, for this contract, I am more insured, I am more really I have the value that if there is anything happened, the bank will cover it to me because I have a guarantee bond, I have a performance bond, and my bank will cover it to me immediately, and he will deal it that later with the bank. He will deal it with the bank of the contractor. The contractor bank will send this claim to the contractor, and if the contractor doesn't respond properly, his bank could block him. Okay, so this is a tight way for both, and it's insurance for all parties that things will go in a very high level. While here, you could do whatever you can do. In some contracts, the client requests from you the insurance policy to comment it, and whatever. You can prepare the insurance, you send it to the client will comment it, and then you close the insurance company. If there is anything occurred, you have to wait, or the client have to wait until the insurance is set and clear. And we know that the insurance policies and the work with the insurance companies, it's not easy to explain in some periods, and some companies doesn't do the proper insurance for the specific contract. They do a general insurance for the company, but they don't care to make a specific insurance for the unique contract, because it will cost more money, which means less benefit. Thank you for watching this episode, and if you have any comment, leave it down in the comment below. I will be happy to reply to all your comments. Don't forget, subscribe, share, and like the video. See you in the next episode.